Hey guys, it's Akeem here. Welcome back to another video. And given all of the volatility in the stock market over the last couple of weeks, I've used that opportunity to pick up some stocks, and I thought that I would share with you what my moves have been. But before we get into that, let's have a look at the S&P 500, right? Because I'm sure we've all been noticing that a lot of our stocks have been falling, or some particular high growth stocks have been falling and falling quite dramatically, right? And we look at the S&P 500 and it's down only 3%. So it's a little bit confusing, right? And that is because the S&P 500 is propped up primarily by the mega tech stocks, right? So effectively the top 5 stocks being Alphabet, Apple, Google, Amazon, and Facebook, they make up about 25% of the S&P 500. And if they're doing well, then generally the S&P 500 is doing well as well. With that being said, the S&P 500 is still down 3%. But when we compare that to the Russell 2000 index, which is an index of the 2,000 smallest companies within the Russell 3000, it tells a different story, right? So we can see here that it's actually down 10% over the last month. And if you're holding some particularly sort of high growth stocks, I'm sure that those holdings over the last month are down significantly more than 10%. But this is a good opportunity, depending on what kind of stocks that you're looking at, for to pick up some more stocks very effectively and lower your cost average. But I think that before you go out and buy a load of stocks that you are bullish on, you need to understand the reasons for the drop in the stocks, right? Because that will help you to understand whether we can expect the drop to continue or whether now might be a good time to buy. So initially this was around some concerns of the new Omicron variant. I'm sure we've all heard about it. I don't need to go into it too much. But effectively, a lot of the newspapers were reporting that we're seeing a drop in the market because of this new variant. And whilst it might have been that for maybe one of the days where we saw a drop, I actually don't think that the Omicron variant is concerning investors much at all. Fair enough, there might be some travel stocks that have been impacted, but by and large, the stocks that we are actually seeing decline, they're not declining because of the Omicron variant. So that is sort of a misconception within the stock market at the moment. So actually the likely reason why you've been seeing a lot of your stocks falling, particularly if you are invested in high growth stocks, is nothing to do with the Omicron variant and everything to do with what Jerome Powell and the Fed have come out and said their intentions are with regards to quantitative easing. So effectively they said that they are going to taper that sooner than what they were initially expected, which will likely result in increasing the interest rates sooner than expected as well. And effectively that means that required rate of returns will be greater sooner, which effectively means that for high growth stocks where you're expecting a lot of the cash flows to be generated far out into the future, you're going to have to discount those cash flows by a greater amount, right? I've got a video on interest rates and inflation if you want to take a look at that, but that's the long and short of it. So effectively, because we are going to be seeing interest rate hikes sooner than expected, that is getting the stock market concerned. So that's why we're seeing the drop. So because we are expecting decreased liquidity and therefore money becoming more expensive in the future, does that mean that we should run off from investing in any growth stocks at all and then therefore moving into value stocks? Well, that is effectively, there is a little bit of a rotation going on at the moment, but if you are a long-term investor and you are bullish on a particular growth stock, then I don't see a massive reason for you to run for the hills at this point, right? So whilst the macroeconomic environment may have changed somewhat, the fundamentals of the businesses that you're investing in likely haven't, right? So you have to bear that in mind. I'm not saying that your entire portfolio should be made up of growth stocks. Anybody that's watched any of my other videos will know that I don't advocate for that. However, I think a good mix between value stocks, growth stocks, cash generative stocks is a good way to play this. Anyway, some of the stocks that I'm looking at. So number one is Asos. Now, Asos is effectively an online retailer that sells all kinds of different clothes, targeting the sort of 18 to 34-year-old range of people, right? And they are kind of similar to Amazon in many respects. Not in the sense that they sell absolutely everything that Amazon does or they're any way comparable in size or growth or anything like that. But effectively, the business model is we are going to operate on very, very low margins to try and be as competitive as possible. And effectively, they want to take up as much of the market share as possible so that they are the go-to retailer. Much in the way that Amazon are the go-to retailer for pretty much everything, right? Asos wants to be the go-to retailer for clothes for people within the 18 to 34 year range. Now, Asos was a stock that benefited massively from the pandemic. As you can imagine, with it being an online clothes retailer and people not being able to visit shops, Their results were really good, and as a result, the stock followed, right? So we saw 450% growth in under a year following the pandemic. And then following that, we've seen pretty much given most of it back, right? So it's now back down to around £23 a stock. But at this valuation, at the current valuation, it's actually looking really interesting. So Asos is a £2.4 billion company. And when you go across to their results, right? So for 2021, their year end ended in August, and they published results of £4 billion in revenue, right? And that was 20% year-over-year growth. And they pretty much grow at 20% year-over-year, and they have done for the last sort of 10 years or so. So they've been putting in fantastic growth. Their margins are very low, but with them trading at effectively £2.4 billion company, they're generating revenues of £4 billion. They're trading at around a 0.6 price to sales ratio. So it's pretty cheap from that perspective. So management came out and said that by the end of 2024, they're expecting revenues of around £7 billion, and they're expecting net margins of around 4%, right? So if we consider what that will be from a net profit perspective, we're expecting £280 million in net profit by 2024. They're currently trading at a value of 2.3 billion. So that'll be a 10 PE ratio by the end of 2024 if it stays at that price, which likelihood is that it won't, right? Even if you apply a 20 PE ratio to that £280 million of profit, you're looking at something like a £5.6 billion company, which is obviously more than double from where it is today within just 3 years' time. So very quick calculation there, but that just goes to show you the opportunity within the stock. So the next stock, which is very similar to the first one, so I thought that it made sense to put these together, is Boohoo, right? And Boohoo, similar story, right? Online retailer, benefited from the pandemic initially, and then effectively due to a load of issues. So think about supply chain issues. Not only that, they've had some governance issues as well, which I will touch on when I come out to release a separate video on Boohoo, when I go into more depth and I have more time to touch on these different particular issues. Effectively, they haven't done so well, right? So over the last year, they are 47% down. And actually now it's trading at pretty much the same valuation as Asos, which is around £2 billion. Now their revenues are a lot smaller. However, they are growing faster and their margins are higher. So as I said, Boohoo is a very fast growing company. So back in 2016, the revenues were £195 million. And then we are expecting at the end of February 2022, so 1 quarter away, we're expecting revenues of £2.1 billion, right? So they've managed to 10x their revenue in just around 6 years. So absolutely fantastic growth, something like 45, even 50% on a compounded annual growth rate basis. And going forward, we're expecting somewhere between sort of 25 and 30% on a compounded basis as well. Not only that, right, their margins are actually higher than Asos's margins. So their revenue is growing quicker and their margins are higher. And the reason for that is because they've got a vertically integrated supply chain. And so effectively, whilst Asos sells the clothes of other brands as well as their own, Boohoo only sell their own brands, and that allows them to have effectively larger margins. In terms of valuation, it's looking quite attractive, right? So for their FY23, which is the end of February 2023, we're expecting net income of £116 million, right? If we go across to what they have historically traded at on a price to earnings basis, if we look over the last 5 years, the average has been 70. It's been as high as 123, and it's been as low as effectively what it is now. So the lowest, it's currently trading at the lowest PE ratio that it has ever traded at least over the last 5 years, and the average has actually been around 70. If we go over to the calculator, right, and do a very quick calculation, so it was £116 million in revenue by FY23, and if we multiply that by a PE ratio of, let's say, in fact, let's go 35, right, which effectively is a lot lower than the average, as we can see there, and it's effectively as low as it's ever been. That gives us a valuation of £4 billion, which would be a doubling of the stock in effectively 2 years' time. Not even 2 years' time, even less than 2 years' time. So clearly, I think there's massive upside in this stock, and that's why I am buying the stock. So remember, at the start of the video, I said it's important to remain balanced with your portfolio. You should have some growth stocks in there, you should have some value stocks in there, have a good mix, right? And that way you will sort of see less volatility within your portfolio. And that is why the next stock that I'm going to be looking at, or the next stock I'll be purchasing, is Discovery. Now, I've already got a video on why I think that this is a brilliant stock, and I think that it is vastly undervalued, and it's just a matter of time, whether that is 1 year, 2 years, 3 years, doesn't matter. which the market realizes the potential here. So you can see that over the last year, the stock has been on a little bit of a wild ride. This massive sell-off here was following the Asos blow up effectively, when Bill Hwang's portfolio, or he got margin called effectively, had to sell off a bunch of stocks, Discovery being one of them, Viacom, CBS being another one, along with a load of other stocks, and that caused this massive sell-off. I think it's important to note that I don't think that the stock should have been trading at $77 a share anyway, but it certainly shouldn't be at the $24 a share that it is now, at least in my opinion. Now, the big play here is regarding the merger that is proposed to happen with Warner Media, and if that deal does go through, I can see massive upside with the stock. And I've actually done a video effectively where I forecasted potential subscriber numbers and how much revenues they could generate and how much profit that would mean for the company. So I'm not going to go into all of the detail here, but effectively that merger with Warner Media is really quite promising. Even if, however, right, the merger doesn't go through, because there's no guarantee that it actually will, even though in all likelihood it probably will. This is a stock that is generating significant amounts of free cash flow, and therefore you can just hold on to it and rest assured that actually its value will go up because it is generating so much free cash flow. So the total enterprise value of Discovery at the moment is around $29 billion. And actually when you look across to how much free cash flow they're generating, for 2021, 2.2 billion, effectively somewhere between 2.2 and 2.3 billion, right? So if we look at 2.2 billion and divide by the total enterprise value, let's call it 29, that is a free cash flow yield of 7.5%. Now, 7.5% as a free cash flow yield is very, very strong, even for a business that isn't growing all that much, right? Usually you would look at around 4 or 5%. So the fact that you're getting a 7.5% free cash flow yield, even though that cash is not necessarily being returned to the shareholders through the form of either dividends or share buybacks, it doesn't matter, right? They can use that cash, that free cash, to pay off debt, reduce their total enterprise value, and therefore increase the return to the shareholder. So I'm not concerned that there isn't a dividend at the moment or anything like that, as long as they use that cash, pay down the debt, or fund the growth in the new company that is going to be merging with Warner Media. And I think that there is significant upside in this stock. Now, one question that I think that people will probably want to know the answer to is whether they should go for Discovery or DISCA effectively, or DISCK, right? Because DISCK actually trades at a discount to DISCA. So people often say, well, what's the difference between the two? And actually the discount isn't actually as much as it used to be. So we've got 23.20 versus 23.99, right? It's not much of a discount, but it used to be a lot larger. Anyway, the question always was, which one should you buy? So effectively, DISCA comes with voting rights, DISCK doesn't. When the merger goes through, everything will be 1 for 1 and everything will be equal. So if you are certain that the merger will go through, then it makes sense to actually just buy the DISCK shares and take up their discount, right? If you're not sure whether the merger will go through or not, liquidity is a lot higher in the DISCA shares because people want the voting rights, and therefore I would recommend going with DISCA, obviously. So yeah, it depends on whether you think the merger will go through. But if the merger does go through, both of those shares are completely equal. So it's up to you. Okay, so the fourth stock on the list, and definitely the second stock classified as a value stock, is British American Tobacco. Again, I've actually got 2 videos on British American Tobacco, so I'm really not going to go into the details of this at all. Effectively, right, it's got a dividend yield of around 8% at the moment. I think that even if the stock doesn't go anywhere within a year, I think that even if you pick up an 8% dividend on that and reinvest those dividends, you're not doing all that bad, right? Because given the environment that we are in, I think you wouldn't be an idiot to say that the S&P 500 might not return 8% per year over the next 5 years, right? It may well do, but given the run that it has been on over the last 3 or 4 years, I don't think you'd be an idiot to assume that, right? So I think that if you collect your dividend, given the amount of free cash flow that British American Tobacco is actually generating, I find it difficult to believe that it's going to go much below a P ratio of around 9. And that's why I think that this is a good stock to hedge against inflation, which effectively is what my previous videos were on. So in terms of its valuation, right, the enterprise value of the stock is £100 billion. You look across to the kind of free cash flow that it's putting in, it's around between 7.5 and 8.5 billion pounds, right? Well, 7.5 billion pounds is 2021, 8.5 billion pounds for next year, which by the way is 8% growth for a business that is very boring and apparently dying, 8.5% growth in free cash flow doesn't sound too bad to me, right? So anyway, £7.5 billion of free cash flow on a £100 billion enterprise company is not bad. Again, it's at 7.5% yield, right, which is higher than the industry standard. So definitely not too bad of a stock to hedge against inflation. And then the next stock on the list is Pinterest. Now, this one is a little bit of a cop-out, and I'll explain to you why that is in a moment. But effectively, I made a video on this probably 2 weeks ago, saying that I think that at $42, I think that this is, I think there's massive potential, right? And I think that by 2025, I think it was by the end of 2026, I see this at almost $90, right? So I think there was significant upside, and that was being conservative with my numbers. If you want to go watch the video, go and do that. I think it's titled, "This is the next big multi-bagger," or something like that, right? Anyway, the reason why this is a cop-out is because I don't actually own the stock. And it's not because I don't want to own the stock, it's because I'm not allowed to own the stock. So what I do in my professional career means that there are certain stocks that are restricted to me, and therefore I can't own Pinterest, right? So it's not a stock that I own, but I do think that it is a really good stock, and I do really like the company. And if I was allowed to own it, then I would. So why do I really like the stock? Well, particularly at these prices as well. This is a $21 billion company by enterprise value. We go across to their estimates, right? This is a company that has been growing at around 50% year over year. We're expecting that growth to slow down, right? But I'm expecting sort of 25% growth for the next few years. But also, this is a company where once the foundations are laid, you don't actually need to spend that much money in order to increase your revenues. And therefore, as your revenues increase, your costs also increase, but by a disproportionate amount. And effectively that results in margin expansion, which of course means that as your revenues are only increasing by say 25%, actually your profits are increasing by something like 40 or even 50%. And that is where you see a significant return on your investment. I show you an example of that here, right? So for 2021, they basically put in 50% revenue growth, fantastic. For 2022, they are looking at 26.5% revenue growth, right? If you go down to net income, we can actually see that their net income is expected to grow by 60% in that same year. So their revenues have increased by 25% or 26.5%, and their net income has actually increased by 60%. And so once you've done this for a few years, it's very quickly that your net income has scaled up incredibly fast relative to your revenues. And as a result of that, you both get significant amounts of profits. There's also potential for multiple expansion as well. And of course, it doesn't take many years of 60% growth in your net income for this company to become ridiculously cheap, right? So if we imagine, or if we consider that $512 million will be their net income by the end of 2022, and we want to know what their net income will be by the end of 2026, let's suppose that the net income growth will be 40% year over year for the next 4 years, which personally I think is actually quite conservative. But let's just imagine what that will be for a moment. We're looking at $2 billion in net income by the end of 2026, right? Now, this is just a very quick calculation to show you how quickly that can ramp up. So effectively, we're at $2 billion in net income by the end of 2026. And this is a company that will be generating margins of something like 25% net income margins. That would put it at a PE ratio today of 10, which is very, very low indeed. What PE ratio would you think would be reasonable to apply to this company? If we go with something like 25, we're looking at a $50 billion company, right? Which is obviously more than double what it is today, 2.5 times what it is today. So I think that the company is definitely has a lot of potential, put it that way. But unfortunately, I'm not allowed to own it. Anyway, I thought that I would put that out there. I hope you guys have enjoyed the video, and until next time, thank you.